Welcome back to the Market Podcast. Asymmetric info for individual investors. Educational info only, not financial or legal advice. Consult a pro before investing.
Welcome, everyone. Today, we're digging into a company that, well, it just constantly sparks conversation, doesn't it? Relentlessly pushing boundaries. Tesla. It's a name you hear pretty much daily, but, we rarely get to really dissect what makes it tick beyond just the headlines. So today, we're going to try and unravel one of the most talked about companies on the planet, a genuine disruptor that goes way beyond just building electric cars. We're aiming to explore its core strategy, its, let's face it, pretty bold ambitions, and what truly underpins its, well, astonishing trajectory. And for you, the individual investor listening right now, we're tackling a really specific but potentially massive question. Will Tesla's insurance business, which kind of seems niche right now, actually become this huge new pillar for the company, especially, with autonomous vehicles and robots moving from sci-fi to maybe reality? What does that mean for transport, for energy, even for labor itself? Our mission really is just to equip you with the essential knowledge, maybe some surprising facts, and the strategic insights you need to truly grasp Tesla's pretty expansive vision. Hopefully, you'll walk away not just informed, but maybe better positioned strategically to understand its future path.
Yeah, absolutely. This isn't just about understanding, a car company. It's really about analyzing a technology behemoth that's aiming to reshape multiple industries all at the same time. We'll be connecting some really fascinating dots today, showing how these seemingly separate parts of their business actually fit together into this one grand strategy.
All right, so let's start at the top then. Who is actually steering this high-speed, futuristic ship? I mean, you can't really talk about Tesla without immediately talking about the whirlwind force that is Elon Musk.
Yeah.
As CEO and co-founder, his influence is just immense and pretty unique. You look at his background, PayPal completely changed online payments, then SpaceX, which is literally pushing into space exploration. These aren't small things. And his, let's call it audacious vision, has propelled Tesla from this scrappy startup to a global powerhouse. You really see his fingerprint everywhere, don't you? From that initial huge bet on the Model 3 for the mass market, which honestly seemed almost crazy at the time, to this relentless push for full self-driving and now humanoid robots. These kinds of big decisions have really defined Tesla's entire path. But it's not just Elon, right? He does have a pretty formidable inner circle. Andrew Baglino, for instance. He's the senior VP of Powertrain and Energy Engineering, been there since 2006, so real veteran. Absolutely crucial for battery tech advancements, and maybe more importantly for investors, those cost reductions that made EVs more accessible. And then there's Rebecca Tanucci. She's the senior director of Supercharging, basically the architect behind scaling that global network to, over 50,000 stalls now. That's just a massive infrastructure achievement, and it's a huge part of the customer experience, something that really sets them apart. You hear people talk about the reliability all the time. And finally, Ashok Eliswamy, director of Autopilot software, he's the one leading the charge on full self-driving, or FSD. And that's obviously vital for the whole Robotaxi launch they keep talking about. So yeah, these are the key people building that future day by day alongside Musk.
Yeah, and what's really striking here, I think, is just how profoundly founder-led Tesla still is. It's almost unlike any other major corporation today, where leadership is often more distributed or kind of tied to legacy structures. Musk's involvement isn't just strategic, he's deep in the operations. His vision, not some, inherited corporate lineage, really drives the whole culture. Look at his track record. He famously steered Tesla to profitability after it was basically on the brink of bankruptcy back in 2008. That shows not just leadership, but some serious resilience and belief in that long-term vision. Now, the obvious concern, and it's a legitimate one, is Musk's other commitments. He's running SpaceX, he's heavily involved with X, the old Twitter. And you have to wonder, how does one person keep focus across such demanding ventures? It's a fair question. Yet despite all that, Tesla's consistently made, remarkable progress year after year, which really speaks volumes about the talent he has around him in that core team. And when you look at how leadership is incentivized, Tesla takes this incredibly aggressive, almost revolutionary approach.
It's all designed to align leaders, especially Musk himself, directly with long-term shareholder growth, mainly through stock. Remember that 2018 pay package? Tied to these mind-boggling milestones like hitting a $650 billion market cap. In 2023, his compensation was valued at something like, $56 billion? An eye-watering number, although it's important to remember a big chunk of that is still unvested because they didn't quite hit some delivery targets. But that aggressive high-stakes model is just worlds apart from, say, GM, where incentives are much more traditional, much less tied to these huge long-term market cap goals. It really fosters a high-risk, high-reward culture focused on those moonshots.
So this aggressive sort of centralized leadership, what does that actually mean for Tesla's culture day to day and its overall direction? Well, at its very core, you've got this incredibly powerful mission statement to accelerate the world's transition to sustainable energy. And honestly, it doesn't feel like just a catchy phrase. It really does seem to act as the company's North Star, guiding pretty much every decision, every innovation. Their vision isn't just EVs, right? It's comprehensive energy storage, like the Megapack. It's this radical idea of autonomous transport with Robotaxi, and now humanoid robotics with Optimus. Musk himself talks about a future of sustainable abundance, where Tesla's tech basically solves global challenges, making resources plentiful. It's ambitious. And that mission seems to fuel this culture of really intense, demanding innovation. We're talking about an environment that often means exceptionally long hours, but it fosters rapid breakthroughs, pushes boundaries like few other places. It's kind of a double-edged sword, isn't it? This relentless pressure drives their incredible speed and innovation, letting them hit seemingly impossible targets. But yeah, it also comes with that inherent risk of burnout and talent turnover. You hear stories. Still, the employees seem genuinely bought into the mission, and you see that in how fast they iterate. I imagine the coffee budget alone must be astronomical.
Well, probably. You'd need it with those hours.
But this unique leadership structure, it does have its risks. Specific challenges for you, the investor, to really think about. First, there's the undeniable Musk dependency. I mean, the reliance on him is so profound that if he were to suddenly step away, well, there'd be huge succession concerns, right? That could create massive uncertainty, hit the market hard. Second, his public statements. They can draw intense regulatory scrutiny. We all remember the going private tweet back in 2018 famously got him in trouble with the SEC. These kinds of public pronouncements can have real, tangible financial consequences. And finally, yeah, that high-pressure environment can lead to talent turnover. We've seen some notable departures, like Milan Kovac, who used to head up the Optimus program, left just recently, June 2025. Now, turnover happens in tech, especially fast-paced companies, but for Tesla, it highlights just how demanding their culture is and the constant need to attract and keep that top-tier talent.
Yeah, and if you put this in a broader context, Tesla's leadership is just so different from traditional automakers like Ford or GM. They often seem to pursue more incremental improvements. Their CEOs focus on optimizing existing lines, making slight tweaks. Tesla, under Musk, it's a whole different game. It's about revolutionary leaps, completely new paradigms. This centralized, tech-driven leadership give them incredible agility. They can pivot fast, make bold bets, push new tech to market at a speed legacy companies just can't match, often because they're tied down by old processes and complex supply chains. But as you said, that centralized nature also brings unique vulnerabilities. Their agility is kind of directly tied to Musk's availability and his focus, which, yeah, it can be a worry for investors. But overall, it's definitely this unique leadership style that gives Tesla a distinct edge, especially in these emerging fields like autonomy and robotics.
Okay, so we've got a good handle on the unique leadership steering Tesla. Now let's shift focus, get into the engine room itself. How exactly does Tesla make its money, and what are the sort of foundational elements that let it consistently disrupt and, well, dominate across so many different areas?
At its core, the business model seems straightforward, but then it gets layered with this remarkable complexity. Okay, they design, make, and sell EVs, energy storage like Powerwall and solar products. Simple enough. But that's just the base layer. The real genius, I think, and where the complexity comes in, is their vertical integration. Unlike old-school automakers, who are often more like sophisticated assemblers relying on this huge web of outside suppliers, Tesla's philosophy is totally different. Total vertical control.
Right. Think of it like Apple designing its own chips, its own OS, even its own app store. It's not just about efficiency, it's about owning every single piece of the puzzle that lets them innovate and adapt at, well, warp speed. Exactly. And now they're strategically pivoting into services insurance, the Robotaxi network everyone's waiting for. For you, the investor, it helps to think of Tesla less like Ford or GM and more like, yeah, like Apple. The hardware, the cars, is the platform that enables this whole ecosystem of software and services like FSD and Tesla Insurance to grow and generate really significant revenue. Their product portfolio is pretty diverse too, and it keeps evolving. We all know the cars in Model S3, XY, and the very distinctive Cybertruck, but the strategic insight maybe is how the Model 3 and Y, those mass market gambles, really became the bedrock of their financial success.
They're the sales champions.
Right. They drive the bulk of the car revenue, and crucially, that allows them to fund the more speculative, high-upside stuff like Robotaxi and Optimus. It's kind of a dual strategy. The reliable cash cow funding these audacious bets. Then beyond cars, you've got robust energy products, Powerwall for homes, Megapack for grid-scale stuff, solar panels for homes and businesses. And the software, that's a huge differentiator. FSD capabilities constantly being refined. Those over-the-air updates mean the car actually gets better after you buy it. Ongoing value. And finally, the services side. Tesla Insurance, that sprawling, super reliable Supercharger network, and yeah, the highly anticipated Robotaxi service.
So this really raises the question. What makes their whole approach so distinctive in an industry that's, been around for over a century? Well, Tesla's model is unique because it masterfully blends three things. Cutting-edge innovation, right? Delivering best-in-class EVs and energy solutions. Then, economic efficiency, mostly through that massive gigafactory scale. And third, this deep underlying passion for sustainability. It feels genuine. Unlike traditional automakers, stuck with dealership models treating software like an add-on, Tesla's direct sales and obsessive focus on software create this truly integrated tech-like ecosystem. And that fosters almost cult-like customer loyalty, allows them to command higher margins. Their whole business model is just built on a different philosophy. It's really hard for competitors to just copy that.
Yeah, that makes sense.
And their track record of adaptability is just as compelling. It gives you critical insight into their resilience. Think about these key moments. 2008, they somehow survived the global financial crisis, partly thanks to that big DOE loan showing early financial cleverness. 2012, the Model S launch didn't just put them on the map. It made Tesla the undisputed leader in luxury EVs, paving the way. Then the infamous Model 3 production hell in 2017-2018. Huge pressure, but they ultimately scaled up for the mass market, proving their operational grit. And just recently, 2023, they deployed a massive 14.7 gigawatt of energy storage. That's a 125% increase year over year, proving huge, rapid growth outside of just cars. This ability to pivot niche luxury to mass market, now to autonomy and robotics, shows this incredible adaptability and strategic foresight. That should be core to how any investor thinks about them.
Okay, we've just unpacked Tesla's innovative business model, but man, executing on that kind of grand scale requires a massive operational backbone. So let's explore how they actually build all this stuff and, crucially, what significant risks they're navigating along the way. They operate with a truly global footprint, right? HQ in Austin, Texas, which is also big for Model Y and Cybertruck. Then Gigafactory Nevada, crucial for batteries, energy storage. Gigafactory California for Model SX, more batteries. And then Berlin and Shanghai, serving those massive European and Asian markets. What's key here, I think, is that Tesla owns most of these facilities outright. That gives them immense control over manufacturing, quality, output. But it also means a ton of capital is tied up in physical assets. While they do outsource some bits, the priority is always in-house for critical parts, keeping those external dependencies low.
Right, and let's dive deeper into that vertical integration. It's not just a buzzword for them, it's fundamental. It's a key differentiator. By controlling everything from those 4680 battery cells, the bigger tabless ones designed for higher energy density, faster production.
Which help cut costs by, what, 14%?
Exactly. So from those cells to their own software, and now even their own insurance arm, they dramatically reduce costs and external dependencies.
Yeah.
You compare that to, say, GM, heavily relying on suppliers like LG for batteries. Tesla's control just enhances their efficiency and responsiveness across the board. It's a significant competitive edge.
And their distribution model is another huge difference. Direct-to-consumer sales. They just skip the traditional dealerships entirely. That gives them amazing pricing control. They can adjust prices quickly. And it gives them invaluable direct customer data. That's a gold mine for product improvement, strategic decisions. Now, it does have limits. Some states still have regulatory bans on direct sales, so they have to operate showrooms without actual sales happening there, unlike, Ford's established franchise model.
State-by-state battles.
Yeah. So when it comes to revenue predictability, how stable is it?
I'd say it falls into the moderately predictable bucket. It's mainly driven by their strong EV sales and those long-term energy contracts. Like in 2023, automotive revenue was, $82.4 billion? That's about 85% of the total. Services like Tesla Insurance are starting to add a layer of stability now. But you have to remember global supply chain hiccups, rapidly changing regulations. Those things can definitely introduce variability. It makes it a dynamic space for investors, for sure.
Okay, and finally, the threats. What's lurking on the horizon?
Well, competition is definitely heating up dramatically. You've got aggressive players like BYD and NIO from China. Legacy automakers are finally launching more compelling EVs.
Right.
Regulation is always a wild card. New tariffs, changes in EV subsidies, those could definitely impact margins.
Geopolitical risks are real too, especially since China is, what, 22% of their revenue? That's significant exposure.
And technology itself, right. If a competitor makes a huge battery breakthrough or leapfrogs them in autonomy.
Exactly. That could potentially disrupt Tesla's current lead. They need constant vigilance.
But despite all that, their resilience really is one of their most striking qualities, isn't it? A crucial point for investors.
Absolutely. They've proven time and again they can weather storms like few others. Think back. 2008 crisis, Model 3 production hell, even COVID-19 disruptions. Through all that, Tesla hasn't just survived. They've often thrived in uncertainty. And that ability, I think, comes down to their highly integrated, data-driven approach. It lets them adapt quickly, effectively. They're almost anti-fragile, often emerging stronger from adversity.
Okay, so every great company has that competitive advantage, that moat, right? Something that makes it incredibly hard to beat. For Tesla, it feels like it's not just one thing, but this powerful combination creating a shield. Let's break it down. First, those almost monopolistic traits in certain areas. The brand. I mean, Tesla is EVs for so many people. That creates fierce loyalty, a strong emotional connection. Then, the Supercharger network. Over 50,000 stalls globally. That's just a monumental infrastructure advantage. It's a real convenience and reliability moat that's hard for rivals to replicate quickly. And maybe most critical, the data. 1.8 million vehicles out there, constantly generating this unimaginable amount of real-world FSD training data. Every single day. That data is priceless. It gives them an unparalleled advantage in developing and refining autonomous driving.
Yeah, it's like every Tesla on the road is a sophisticated data collector feeding info back to the AI constantly. Millions of silent interns tirelessly learning, improving the system every second. It's incredible.
And then there's economies of scale. Those gigafactories aren't just big. They produce at immense scale, driving down manufacturing costs. Gigafactory Nevada alone supports, what, 1.5 million vehicles annually? That massive scale let them slash battery costs by 30% since 2016, makes the products more competitive, boosts profitability.
And the network effects are just incredibly powerful here. You know, like a snowball rolling downhill, the more snow it picks up, the bigger and faster it gets. That's the Tesla ecosystem. Every new vehicle sold isn't just a sale. It's another data point improving FSD for everyone. Another car plugging into the Supercharger network. It reinforces this powerful, virtuous loop, making the whole system more valuable with every new user.
Yeah, that makes total sense.
And what's really clever, I think, is their strategy of counter-positioning. They didn't just try to build a better car, they built a totally different kind of company. Their direct sales model, that unwavering focus on sustainability. It fundamentally sets them apart from legacy automakers. Those guys are often burdened by dealership networks, decades of combustion engine expertise, a slower pace. They just struggle to match Tesla's software skill and agility. It's not just competition, it's like they're playing a different game on a different field, where Tesla has this structural advantage.
And that leads to high switching costs for customers too, right?
Exactly. Once you're deep in the Tesla ecosystem, relying on superchargers, maybe subscribing to FSD, using Tesla insurance, it gets pretty costly in time and money to just switch brands. It's a powerful lock-in, fosters loyalty, recurring revenue.
And we can't forget the brand power itself.
Oh, absolutely not. Tesla's brand just screams innovation, cutting-edge tech, sustainability. It lets them command premium pricing, even while scaling to the mass market. Their cultural impact is up there with companies like Apple. It's an aspirational thing, goes beyond just owning a car. It's being part of something.
It really does seem like they've cornered some formidable, unique resources. Proprietary batteries, like those 4680 cells, giving them a cost and performance edge. That advanced FSD software, years ahead of many rivals. And maybe most importantly, their ability to attract the absolute top AI talent globally. That creates a brain trust that's incredibly hard for anyone else to replicate. These are unique, hard-to-copy advantages building that shield.
And beyond just resources, their process power is incredible. Manufacturing efficiency at the gigafactories allows production at a scale and speed that's truly remarkable. And that rapid software iteration, weekly FSD updates. It means their products are constantly improving almost in real time. That's mastery of both hardware and software integration, a unique operational strength.
And speaking of proprietary tech, FSD and Optimus, the goal for FSD is to be 10x safer than human drivers if they hit that. Revolutionary for transport safety. Then Optimus, the humanoid robot, potential to transform global labor, both are proprietary, gives Tesla this significant, almost unassailable lead in these huge emerging sectors.
Which brings up a key question for long-term investors.
Yeah.
How sustainable are these advantages? Well, their strategic timing was just impeccable. Entering EVs just as global sustainability concerns were rising, that secured critical first-mover advantages brand. Infrastructure like superchargers. Perfect timing.
Their speed of execution is legendary.
Right. The Model Y concept to mass production in just 18 months. Compare that to GM taking years for their Ultium platform. Tesla's ability to iterate and scale rapidly gives them this continuous lead, forces others to play catch-up.
So the moat seems durable?
Largely, yes. It's tied to these enduring secular trends, electrification, automation. These aren't fads. They're fundamental shifts. That ensures Tesla's relevance. But, and this is crucial, continued innovation is absolutely key. They can't just sit back. Constant reinvention is required.
Because there is potential for erosion, right?
Oh, definitely. We have to acknowledge that. Competitors are catching up, especially in EVs. It's getting crowded. Regulatory shifts, new tariffs, safety standards could impact their model, and persistent global supply chain issues could still create bottlenecks, erode their lead. So yeah, the moat is strong, but it's not impenetrable. Constant vigilance and innovation are needed to keep it strong.
Okay, so where does Tesla go from here? Their ambitions are, well, monumental doesn't quite cover it. They're not just aiming for steady growth. They're targeting truly transformative expansion. For you, the investor, it looks like a four-pronged attack on several new, absolutely colossal markets. First, market penetration. Just keep increasing EV sales in core markets like North America, Europe. Keep taking share from traditional automakers. Second, market development. Actively expanding into new territories. Eyes on massive emerging markets, India, Southeast Asia, where EV adoption is early but could explode. Third, product development. This is really exciting stuff. Cybertruck is out there now. The highly anticipated $25,000 EV that could unlock a whole new buyer segment. Launching the Robotaxi network. Scaling Optimus, the robot. These aren't just new cars, they're entirely new product categories, each with immense potential.
Game changers.
And fourth, service expansion. Scaling up Tesla Insurance, we'll get deeper into that soon, and significantly expanding their energy storage solutions. It's about building out the whole ecosystem around the core products, creating new revenue streams.
And what's just remarkable here is the sheer scale of the growth potential they're targeting in completely new industries. We're talking numbers that are frankly mind-boggling. Robotaxi, for instance. The potential to generate maybe $100 billion annually by 2030. That's a revenue stream that could dwarf their current car sales. It would fundamentally alter their whole financial profile.
Wow, okay.
Energy storage is already booming, 125% year-over-year growth, and they're not just aiming for home power walls. They're targeting massive grid-scale markets, aiming to be a huge player in the global energy transition. And then there's Optimus, the humanoid robot. This could potentially address global labor shortages. The goal is millions of units by 2030. Just imagine the scale of that market. Revolutionizing manufacturing, healthcare, who knows?
So how big are these markets overall? The total addressable markets, the TAMs?
Right, the TAMs by 2030 give you context for the investment thesis.
Yeah.
EVs, roughly $1.4 trillion market. Energy storage, projected around $400 billion. Autonomous vehicles, with Robotaxi leading, a monumental $1.8 trillion market. And robotics, especially with Optimus, potentially exceeding $1 trillion. Tesla is positioning itself to grab significant chunks of these enormous high-growth markets. That creates this truly diversified reach, supporting long-term growth and resilience.
And their applications are incredibly diverse, too.
Exactly. It's personal transport with EVs, fleet logistics, home and business energy, grid solutions with Megapack, ride-hailing with Robotaxi, manufacturing, healthcare, households with Optimus. This broad reach means they aren't overly reliant on any single sector.
Yeah.
That's a robust foundation.
It really sounds like they're building an empire. But even empires face risks, especially growing this fast into so many areas. Let's talk supply chain diversity again.
Sure. While they do source globally, and yeah, about 50% of batteries come from China right now, there's significant in-house production for key parts. Unlike competitors, totally reliant on external suppliers, helps mitigate a lot of that risk.
Like GM being more dependent on one battery supplier.
Precisely. Tesla's approach gives them more control, more flexibility. That's a key operational advantage.
And customer diversity, serving consumers, fleets, energy firms.
Yeah, that reduces reliance on any single segment. If one area slows down, others can provide stability. It's a key part of their resilience, reassuring for investors.
And their longevity seems tied to these big trends, right? Electrification, automation.
Absolutely. These aren't fads. They're fundamental long-term shifts in how the world will work. That alignment ensures Tesla's relevance, gives them a high probability of continued success, and their proven resilience to downturns just underscores that.
But we need to be clear about the main risks to that growth.
Definitely. Competition remains fierce. BYD and EVs, Waymo and autonomy. Global supply chain bottlenecks are still a potential issue, impacting production. And critically, regulatory delays, especially for autonomous vehicles, could slow down robotaxi rollout and hit those anticipated revenues. It's a complex landscape.
Okay, let's talk numbers because, at the end of the day, investors want to know if these grand visions actually translate into cold, hard cash. We're not just going to throw figures at you. We'll try to dissect Tesla's key financial metrics, compare them against peers, and ask that ultimate question. Does the current valuation really stack up against this ambitious future?
Okay, so a quick financial snapshot for 2023. Tesla reported revenue of $96.8 billion. That's a solid 38% year-over-year increase. Strong top-line growth. Their gross margin was 18.2% in Q4 2023. Now, if we apply the rule of 40%, that benchmark for software and high-growth companies, summing revenue growth and profit margin, Tesla hits an impressive 56%. That indicates really efficient growth. Their return on equity, ROE, was a strong 24.4%. Excellent returns on shareholder capital. Financially, they look healthy. $26.1 billion in cash versus just $2.9 billion in debt. Lots of liquidity, flexibility. Free cash flow was $4.4 billion, up 33% year-over-year, crucial for funding all that R&D and expansion.
And energy storage, 14.7 gigawatts deployed, up a staggering 125% year-over-year. Explosive growth in that segment.
How does that compare to peers, though, like GM or Ford or even Apple?
Good question. So Tesla's gross margins, that 18.2%, comfortably beat GM's 15%. Shows more efficient production, stronger pricing power in automotive. But they still lag way behind a tech giant like Apple, which boasts margins around 43%. Highlights the difference in business models. Making physical stuff usually has lower margins than pure software. Meanwhile, Tesla's ROE, that strong 24.4%, is significantly better than Ford's 14.6%. That signals really excellent returns on shareholder capital, efficient profit generation from their equity, testament to their operational leverage.
What about trends? Growth slowing, margins pressured. Yeah, looking at trends, revenue growth is slowing slightly. That's largely due to those strategic price cuts they made to boost demand and fight off competition. As a result, margins were under some pressure, but they seem to be stabilizing now. Crucially, though, their robust cash flow keeps supporting that vital R&D in autonomy and robotics. That consistent cash generation lets them keep investing heavily in the future, which is absolutely key to hitting those ambitious long-term goals.
Okay, but the biggest question for any investor, always, what's it worth? Is the price justified? This brings us to that idea of the margin of safety, right? Buying something for less than its intrinsic value.
Exactly. And Tesla's price around mid-2025, roughly $180, gives it a market cap near $750 billion.
Okay.
That kind of valuation demands really rigorous scrutiny of future cash flows. You're essentially buying into a massive amount of projected future success, not just current earnings.
Which is why valuation matters so much for you, the listener. It determines if those incredible growth prospects truly justify the current price, especially with Tesla's notorious volatility. It swings wildly, right? Based on news, Musk's tweets, market sentiment.
For sure. Understanding the valuation helps you gauge if you're getting a reasonable deal on that future growth, or if you're potentially overpaying for promises.
So how do you value something like Tesla? A standard DCF model seems tricky.
Yeah, a discounted cash flow model is really challenging because the future cash flows from Robotaxi and Optimus are just so uncertain right now, predicting revenues for entirely new industries years out. It's more art than science. So relative valuation gives some insight. Tesla's price to earnings, or PE ratio, basically how much investors pay per dollar of earnings, often sits around 60x. That's way higher than GM's 5x, but it aligns more with high-growth tech firms, not traditional automakers. The market sees it as a tech company.
And then there's that options value idea.
Right. The potential for massive success in autonomy and robotics adds this significant layer of speculative high upside value that traditional metrics don't easily capture. It's like buying a lottery ticket with maybe a high probability of winning, but the exact jackpot size is unknown. Enticing, but definitely risky.
Which leads straight into the classic bear versus bull debate.
Always. Bears say it's wildly overvalued, point to slowing EV growth, potential autonomy delays. Bulls argue the price is justified by leadership in EVs, the transformative potential of autonomy, the groundbreaking prospects of robotics. Our probable thesis here leans bullish, but with a very clear acknowledgement of the huge execution risks involved. Currently, Tesla trades at a premium. 60x PE isn't a discount stock by any means, but those truly immense growth prospects are seen as the strong supporting factor for that premium.
All right, buckle up. it's time to tackle our central question. Could Tesla Insurance, of all things, actually become this colossal new revenue stream? It sounds kind of mundane, maybe, but it's anything but. Okay, Tesla Insurance launched back in 2019. Its growth, meteoric. In 2023 alone, $497 million in premiums. That's a stunning 115% year-over-year increase. Rapid expansion for something relatively new.
Right.
And Elon Musk himself made this really bold projection. He estimates Tesla Insurance could eventually become 30–40% of the automotive business. Now think about that. Automotive revenue was $82.4 billion in 2023. That implies a potential market of $24–33 billion just for insurance.
Wow.
Yeah. This isn't some small side hustle. This is potentially a Titan-sized business in its own right. Could fundamentally change the company's whole revenue mix.
And what's really integral here is how this insurance arm directly plugs into their autonomous ambitions. That highly anticipated Robotaxi network trial, starting soon in Austin, maybe 10–20 vehicles initially. You'll almost certainly rely on Tesla Insurance. The company is totally poised to self-insure its own Robotaxi fleet. And it makes perfect sense, right? They can leverage their unique, unparalleled vehicle data, driver behavior, road conditions, vehicle performance to manage risks with incredible precision.
Mm-hmm. Data they own.
Exactly. This vertical integration just slashes costs compared to using third-party insurers who simply don't have access to that same granular real-time data. It creates this powerful competitive advantage right from the start.
And the market opportunity is huge.
Massive for investors. The autonomous vehicle insurance market alone was valued at $22 billion back in 2022, projected to surge to $88.1 billion by 2032. That's a colossal opportunity. And Tesla, by self-insuring and leveraging its data, is perfectly positioned to capture a big slice of it. They basically shift liability internally and create a whole new profit center.
Okay, wait. What about Optimus? The humanoid robot. Could insurance play a role there too?
Yeah, that's interesting. The exact role of insurance for Optimus is less clear right now, but it's undeniably highly promising. Think about it. If Optimus robots are deployed commercially, factories, warehouses, maybe even homes, eventually there will be a need for liability coverage. That creates this entirely new niche market that Tesla, with its existing insurance expertise, could uniquely step into.
A whole new insurance category.
Potentially. The robotics insurance market is just nascent, it's emerging. But Tesla's experience with vehicle insurance puts them in a unique spot to innovate and maybe lead in this space. If Optimus really scales to millions of units by 2030, like they aim for, then insurance for these robots could absolutely become another significant new revenue stream, diversifying Tesla way beyond just cars.
So the combined potential for Tesla Insurance really hinges on a few key things then.
Yeah, I see three main drivers. First, capturing a big share of that booming $88.1 billion autonomous vehicle insurance market. Second, potentially creating and dominating an entirely new insurance category for robotics. And third, maybe most crucially, leveraging that data advantage. Tesla's real-time vehicle data lets them do ultra-precise risk assessment. That means potentially more competitive pricing for customers, which creates that powerful virtuous cycle. Better pricing attracts more customers, generates more data, improves pricing further, and so on.
But there are challenges, right? Hurdles.
Oh, for sure. Regulatory hurdles are significant. Insurance is regulated state by state. That means lots of approvals needed. And you've got competition from established giants like Progressive. They're formidable players.
Still, if you connect it to the bigger picture, the whole ecosystem, vehicle, software, now insurance, it creates this formidable barrier to entry for competitors, doesn't it?
Absolutely. It's a powerful self-reinforcing loop. Each piece strengthens the others, making the overall value proposition incredibly robust.
So this raises the question, is Tesla Insurance an asymmetric opportunity for investors? High risk, high reward?
I'd say absolutely. It's a high-stakes, high-reward play. If autonomy and robotics hit those incredibly ambitious goals, then insurance could dramatically diversify Tesla's revenue, make it far less reliant just on EV sales. It transforms Tesla from just a company selling products into a company also providing these crucial, potentially high-margin services for a future where intelligent machines are everywhere. It's an investment that could truly pay off exponentially if their vision for an autonomous robotic future fully materializes. It could shift the entire financial landscape of the company.
Wow. Okay, well, we've journeyed through Tesla's visionary leadership, explored its ingenious business model, dissected those really powerful competitive advantages, and peered into its genuinely mind-boggling growth aspirations. What an incredible ride this has been. The core insight here, I think, is that the future of Tesla isn't just about cars or even just energy. It's really about this deeply vertically integrated ecosystem where something seemingly mundane like insurance becomes this vital cog in the machine. It's the strategic piece that could potentially unlock immense value from their autonomous and robotic ventures, transforming their entire financial picture and really redefining what it means to be a tech company today. So as you, the listener, consider the future of transport and technology, maybe ponder this. If the cars and robots of tomorrow manage themselves, how will the world of liability and risk adapt? And maybe more importantly, who will be the ultimate beneficiaries of that transformation?
Indeed. Tesla remains a profoundly compelling opportunity, doesn't it? Masterfully blending automotive, energy, cutting-edge tech to redefine whole industries. While risks like competition and complex regulations definitely loom large, its truly unique approach, leveraging data, vertical integration, especially with its growing insurance arm, positions it right at the forefront of a genuinely transformative future. It's a company that's not just adapting to the future, it feels like they're actively building it, piece by calculated piece.
Love this? Drop a like, subscribe, and ring the bell so you never miss a podcast.